So again, trading comps valuation and transaction comps valuation are fundamental and widely used tools in corporate valuation. And comparing these two methods is also a very frequent topic in interviews. So let's assume we're valuing the same company using two different methods, one based on transaction comps and one based on trading comps. Which method do you think would yield a higher valuation? Well, the answer is pretty straightforward. Generally, transaction comps, this generally result in a higher valuation. But why is that? Number one, there is one major difference between these two valuation methods. Transaction comps, they typically collect data from past M&A transactions, whereas trading comps apply to scenarios as simple as trading just one single share of stock. So in other words, trading comps valuations, they base their valuation purely on the market price of shares being traded. But in contrast, transaction comps, they account for the value of acquiring control of the entire company. So this is known as the control premium. For example, let's consider a scenario where you acquire 49.9% of a company's shares versus a scenario where you acquire 50.1%. Well, it's only a 0.2 percentage point difference in ownership. The implications are vastly different. With that 0.2 percentage point difference, we can gain a significant control and influence over the company. Something we wouldn't be able to do with 49.9%, even though that is also a substantial stake. So in M&A situations, if acquiring full control is possible, buyers are often willing to pay a premium for that control. So this is why control premium plays a significant role in transaction comps. In fact, historical global data shows that the control premium is typically it ranges between 20 to 30%. So for instance, if let's say that the company's stock price is priced at $100 currently, but it's common for the buyer to pay $120 to $130 during an M&A deal. And for reference, these kind of data, they are sometimes published in annual reports by organizations like KPMG or Deloitte. They have vast data on the control premiums. They have it by industry, they have it by geography. Sometimes it can be very helpful. And one more thing, in addition to control premiums, this is not like a very mutually exclusive case, but there's a related concept. It's also the synergy effect that plays a crucial role in M&A. So, for example, let's say that if a private equity fund is acquiring a company, well, in this case, the fund's primary gain would only be financial returns. But let's say if a competitor acquires the same company, for example, if there's a scenario where Delta Airlines maybe acquire American Airlines, merging these two companies, there's going to be a significant reduce in operational costs, and there's going to be a lot of synergies in terms of revenue as well. So these kind of cases, because of the synergy effect, the competitor will be glad to offer a much higher price than a typical private equity fund would. So in conclusion, two things. Number one, control premium, and number two, synergies. These two typically makes transaction comps valuations 20 to 30% higher on average than trading comps valuations. And of course, because of those reasons, usually, trading comps valuations are generally more relevant for tasks related to equity research or in IPOs or anything that value a single value of stock price or one single share. But on the other hand, transaction comps, they're better suited for evaluating M&A deals or analyzing fair acquisition prices. Of course, if you have the time, it's most ideal to apply both methods, compare their strengths and weaknesses, and carefully consider the implied control premiums. And lastly, in terms of DCF, so some interview questions, they ask where to place DCF. Is it on the front, is it in the middle, or is it the highest? Well, there's not a definite answer for DCF. It could actually land anywhere. It's very flexible, this valuation methodology. But the reason is, well, it has so many assumptions. For instance, if somebody gave me a company to value a company using DCF, maybe I can make it $1 billion in equity value. Maybe I can make it in $2 billion in equity value. So it depends highly on the assumptions that I make. That's the characteristic of DCF. But usually it does, result in very higher valuations, because usually the person who's modeling this, DCF model usually has incentives to increase the company value. So if I were to answer it in an interview question, I would probably say that DCF, results in the highest, but still it can be controversial. So up to this point, we've summarized the relationships among trading comps, transaction comps, and DCF as well. They all have its advantages and disadvantages, so it is very crucial to choose and apply the method that best suits your specific situation.